The asset turnover ratio is a measure of a company's ability to use its assets to generate sales or revenue, and is a calculation of the amount of sales or revenue generated per dollar of assets. The formula for the ratio is as follows: sales or revenues divided by total assets. A higher number is preferable since it suggests that the company is using its assets efficiently to make money. A lower number may convince a company to try other methods to help maximize the efficiency of its assets. Nevertheless, this ratio varies between industries and can only be compared effectively between businesses in the same sector. Asset turnover is usually calculated annually, either for the fiscal or calendar year. The total assets may also be the calculated average of assets at the beginning and end of the year. For example, Mart has an asset base of $400 million at the beginning of its fiscal year. The company sees its asset base increase to $500 million by its fiscal year end, which means that it had an average of $450 million in assets for the fiscal year. During that same fiscal year, the company generated $250 million in revenues. Thus, the asset turnover ratio is $250 million divided by $450 million equals 0.56. Since Mart is a big box retailer that sells clothing and household goods, its asset turnover of 0.56 is below the retail industry standard. Asset turnover ratios should be higher for companies in consumer staples sectors, since these businesses tend to have small asset bases but a high volume of sales due to competitive pricing. For comparison's sake, the retail giant Walmart had an asset turnover of 2.37 in 2012. As a result, Mart CEO Rip Smiley decides to restructure the company in order to improve efficiency.